Thank you for watching this video. We always appreciate you liking and sharing our content. You can remember to reach out to your D.A. Davidson investment professional to discuss investments that suit your specific objectives. Over the past couple of months, we have provided a lot of content with experts here at D.A. Davidson. In November, we talked to Gil Loria about potential AI bubble risks. In December, we talked about the U.S. consumer with Michael Baker. And in January, James Reagan shared our 2026 economic outlook. We've included links to all of those videos in the notes. Today, I will discuss our tactical thinking for 2026, our areas of greatest conviction, and the important events and trends that will determine the course of the markets for the rest of the year. We project positive returns for this year, but volatility is likely to continue into the midterm elections in November. So where do we have conviction? We continue to believe in the opportunity in AI. 2025 ended with skepticism about AI's potential and concerns about an AI bubble. Investors claimed that technology was overhyped and that stocks were trading at stretched valuations. 2026 has done a complete 180-degree turn from skepticism to complete determinism. After Anthropic introduced specialized agents for specific enterprise functions, hundreds of billions of dollars in market cap evaporated from supporting enterprise software companies in a matter of days. The debate has shifted from if AI will replace jobs and whole business models to assuming the change is imminent. There is flawed logic in the market's reaction. Consider that many of the enterprise software companies hit the hardest are providing most of the capital and sales needed to build the AI infrastructure and bring about their own demise. We don't argue against the logic that AI will change the profitability and capital intensity of software, or that investors need to revisit how certain companies are valued. We largely disagree with the view that enterprise software companies' only advantage came from their familiar user interfaces and historical lines of code. Our second area of conviction is targeted infrastructure investment. We continue to like power generation and infrastructure themes and companies that will benefit from defense spending. There's money to be spent and strong demand for products and services in these areas in the current environment. And the fact that investors are more convinced AI is real only makes the spending on power and infrastructure more likely today. Meanwhile, the current state of geopolitics continues to fuel increased defense spending. We don't see either of those trends de-escalating anytime soon. Our third area of conviction is around the U.S. consumer. Consumers will continue to spend in 2026. Tax rebate checks will help, especially in the first half of the year, and consumers will be aided by the Trump administration's focus on the midterm elections and improving affordability. Our greatest conviction is on two themes: consumers trading down and stretching their money further, and the second theme around retailers that can pass on cost savings to their customers. We largely believe the U.S. consumer is focused on saving money more so than they are on branding. So moving on to the areas that we think will shape a lot of the outcome for the end of 2026. We continue to wait for a ruling from the Supreme Court on IEEPA tariffs. If the court rules against the administration, it creates multiple challenges. First, will there be rebates for the tariffs that have already been collected? And what will that look like? What will that process entail? Second, will the Trump administration decide to renew the current blended tariff rate under statutes already granted to the executive branch by Congress? Especially if the House, and less likely, but possibly even the Senate, are at risk during the midterm elections. Voters so far believe that tariffs are inconsistent with their concerns about affordability, and imposing seemingly new tariffs could be politically unpopular. Even if the administration postpones tariff policy until after the midterm elections, it poses some risks for the market. The implied increase in fiscal deficit spending would be negative for interest rates because of the implied increased issuance of Treasury bonds. Lastly, we remain very focused on the U.S. jobs market. Labor data remains a source of confusion and potential concern. BLS data, after the most recent revisions, shows that total private job growth declined from 1.2 million jobs in 2024 to just over 600,000 jobs in 2025. Despite the often talked about 900,000 job reduction by the BLS, that wasn't quite as surprising to us. The more interesting thing has been just the complexion of job growth. First, all of the job growth in 2025 could be attributed to private service jobs. 882,000 jobs like healthcare and leisure and hospitality. Going deeper into the jobs data, we're interested to watch how construction and manufacturing demand develops. In 2025, on the bottom of this chart, we show that there was no increase in demand for these types of jobs. And those job openings should be increasing given the level of activity that we're seeing in construction. It was encouraging to see that trend change in January with 33,000 construction jobs and 5,000 manufacturing jobs created. We're watching to see if that pace or that trend continues or if it was just an aberration in January given the bad weather and a couple of other factors in the way that the data was collected. More importantly though, it will take a lot of job growth in that area to have a meaningful impact on the U.S. labor force. And given that we already have a sub 5% unemployment rate, it will raise the question of if we have enough workers to fill those jobs. Ultimately, employment drives consumer confidence and spending. So it's going to be important that these jobs are created, not just for that reason, but because it feeds back into our earlier areas of conviction. Thank you for watching this video. For specific recommendations and advice, please contact your D.A. Davidson investment professional.